Hi, this is James Full Capital, and I'm here with Bard Hoover to talk about a new deal. So, welcome to the show, Bard.
Thanks. Thank you, James.
All right, so maybe to kick it off, give people a little bit of your background, and then a couple minutes just on what you're seeing in the market right now.
Yeah, you bet. So Bard Hoover, Marcus and Millichap, we're with the Fluellen-Hoover multifamily team here. Nick Fluellen and I run the team. We have 19 people on our team now. And we have 6 or 7 guys now that do secondary markets for us. So we're looking New Mexico, West Texas, Central Texas, East Texas, Oklahoma, North Louisiana, and Arkansas. And then we have 2 guys that do 75 units and under on the team. It's divided up. One is Tarrant County, one is Dallas County. And then we have 6 of us that focus on DFW, the larger deals, 76 units and greater. And so we have 5 support staff. And I mean, last year we did 70 something deals and over $1 billion in total volume. And so it's been a good run.
It's been a good run. So, in terms of, so you're focused in on probably 75 units up. Really, DFW is your focus day in and day out. Like, what are you seeing right now in terms of buyer appetite, in terms of why sellers are selling right now?
I would say, well, first of all, why sellers are selling. I would say sellers are selling because they're hitting, their NOI, their projected year 5 NOI in year 2 or 3. And so a lot of them are just going full circle and taking some chips off the table. We've seen incredible organic rent growth in DFW over the last year. I mean, to the tune of like 17%. I think there was a lot of pent up demand during COVID. And so a lot of these owners are now taking advantage of this rent growth that we're seeing. And so as that shoots up, then their NOI goes up. And then, now we're looking at values that a lot of sellers just can't believe we're there, but we are. And so, it's tough as far as buyers go. I mean, it's a very competitive market here. There's still a lot of capital that's coming from both coasts. We've always seen a migration of money to Texas, and specifically DFW. But, in the last year since COVID and all these crazy laws on both coasts and rent control and all that, we're seeing even more. And so, what happens with that is it creates a very competitive environment here. So, prices, and when there's more demand, then obviously prices go up. And so we've seen cap rates compress from 15 to 18 months ago. We've seen cap rates compress over 100 basis points. And so, for a, class B in a class B submarket like this asset is, Oats Creek, you're looking at, a 3 to 3.5 tax adjusted going in cap rate. I think the way a lot of buyers are underwriting these deals these days is it's not about going in cap rates and it's not about yields anymore. It's all about IRR and equity multiples. And so I think if they're looking at a deal and they're saying, I may not be able to pay my pref for the first couple of years, but if I can double the money for the LPs in these deals in 3, 4, 5 years, does it make sense? And everyone says yes. As an LP, I'm in. That's where we are in the market. It's extremely competitive, but there's a lot of velocity right now, so there's a lot of opportunities.
Yeah, I mean, on a monthly basis, it seems like the market is moving pretty quick, and by the time you get a deal under contract, you're in the money pretty well by the time you close. So the market's
Right.
just moving super fast. So let's start jumping into this deal. Sort of, let's get into location and where this deal sits in DFW.
You bet. So it's Oats Creek, 280 units built in 1984. It's in Mesquite. It's just off of 635 on the northeast side of 635. You can see I-30 is right there, so it has incredible access to 635, which goes around the Metroplex, and then I-30, of course, will shoot you into downtown and then take you all the way to Fort Worth. So Some of the drivers in Mesquite, Town East Mall is just south of the property, has $1.2 million or 1.2 million square feet of retail. There's a UPS distribution center with over 1,000 employees. Pepsi Bottling Company is right there. Eastfield College has more than 16,000 students. So it's an excellent submarket. Honestly, there's not a lot of velocity. There's not a ton of product in Mesquite, and there's not a ton of velocity. So it's a very desirable market. It's a market that pretty much, it's very rare that I ever hear anyone say, I don't want to be in Mesquite. So everyone is at least, privy to looking into the deal.
All right. So let's go through sort of what sort of maybe talk about what on the exterior, what's been done, and maybe some on the interior, a little bit about maybe the interiors and what they've done so far, the seller.
Yeah, so the exterior is very clean. We don't know the age of the roofs. We think they're about 10 to 12 years old, but they are dimensional shingles, and they don't have any. The management said they don't have any issues with leaks or anything like that. It is a lot of the wood has been replaced with hardy, not all of it, but a lot of it has, and then it's brick as well. So there's average unit size is 786 square feet. This just some of the attributes of the property. There's connections, washer dryer connections in every unit, and they actually lease back washers and dryers. So they lease from a company for between $25 and $30, $25 for full size and $30 for stackable, and they lease them back to the tenants for $50. There's individual HVAC, it's individually metered, 4 boilers for hot water. And the age of those is you might need to replace a couple of those, but they're still running fine. And so most people are like, I'm just going to go with it until something happens. But just in general, the exterior is very clean. There's not a lot of deferred maintenance on this property. Concrete parking lots in good condition. Where you spend money is going to be on the interiors mostly.
Okay, so I think the seller maybe has done a few interiors, but not done 75% of the units. So maybe talk about we can get into maybe a little bit of the unit mix, and then where you see sort of classic units going versus upgrade and maybe even lease trade outs.
Yeah, so back in the day, we'll say 4, 5, 6 years ago, what was considered an updated unit was vinyl flooring, two-tone paint, spray the countertops, cabinet pulls, black appliances, some kind of a backsplash, maybe a lighting package. That was updated. That's not updated today. That's just a turn. In today's world, on these Class B and Class B submarkets, what you're seeing is this platinum level, and so we're seeing properties bite off and take a small number just to show proof of concept that you can do this and deliver these and get premiums. And so what they did is 4 units they actually took to the platinum level. And what that includes is quartz countertops with an undermount sink and a sprayer faucet, white subway tile backsplash, cabinet fronts, stainless appliances, quartz in the bathrooms, lighting package, and of course the two-tone paint and the vinyl flooring. And so we're seeing, big pops and premiums on this platinum level. And that's where these properties are going. So the next owner needs to come in and take 30, 40, 60, 70% of the units up to that platinum level and then receive the benefits of that. So what they've been able to get on these platinum units is a $175 premium for a 1-bedroom and a $200 premium for a 2-bedroom unit. Now, that being said, they're also on their last 25 leases on their trade out report, they're getting 11% organic rent growth on the property without doing anything to the interiors, which equates to about $110 a month. And so if you layer on the platinum level on top of that, they're getting 110 plus 175 for the one. So you're looking at $285 premium for the 1-bedrooms, taking them to the platinum level. And then for the 2-bedrooms, they're getting a $200 for the platinum plus the 110. You're looking at a $310 premium to take the 2-bedrooms to the platinum level. So that's the lowest hanging fruit on this deal. It's very simple. You're going to ride the wave of organic rent growth, and then you're going to go in and upgrade units to the platinum level.
So right now rents are, let's call it 1050 to 1100, and you think you can get them, let's say 250 on average up. So you're still in,
Yeah.
1200, $1,300 range on this deal. Okay. All right. Yeah, I mean that's what we're seeing across DFW really. And then so here's some floor plans. It looks like majority. So all the units you said had washer dryer connections already.
Every unit.
Okay.
Yes.
All right. And then all right. So we talked about the unit upgrade program. What are some of the other value add pieces in this deal that people should be looking at?
So other ancillary income opportunities on the property, water conservation. We got a water conservation quote for approximately $110,000 in annual savings if you implement a water conservation program. What's interesting is through COVID, everybody put all their capital projects on hold. Whether that was to go in and do a bunch of add community amenities or water conservation, because no one knew what was going to happen with COVID. They were worried, is my occupancy going to go to 60 or 70%? I got to hold on to this money in case I need it for debt service. And so everyone put these projects on hold, and tenants didn't want people going into their units. And so the benefit of that is for these next buyers coming in, they get to go in and do these capital programs. And so, yes, water conservation is one of them. $110,000 savings annually, which is huge. So that's a no-brainer. There's also 85 first floor patios that could be extended into little backyards. So we put in there $75 premium to do so. It'll probably cost you $1,200 to $1,400 per, depending on the size of it. But tenants love that, to be able to let their dog out when it's raining to go to the bathroom, or let their kid out, and that they're safe. And so that's one of the other ancillary income opportunities. They also have covered parking, and they're not fully leased. They haven't been aggressive with leasing the covered parking. And so they're getting $50 for each space. So I would push that campaign, and I would push it up to actually $60. And then you could also do just reserve parking as well, where there's no covered parking. So that tenant can get that space right in front of their unit. You're looking, $25 to $30 premium for that. And then you could, we found some sources that actually where you can lease washer dryers for more like in the $20 to $25 range, in the low 20s. They're currently leasing for $25 to $30. And so, and then leasing them back to the tenants for $50. So you could push that and try to sell that more to the tenants to get more income that way. There's also the storage at the back part of the property is 2 stories, and the top story could be turned into a unit. So you could actually turn it into a 1-bedroom and make this a 281 unit property and get that income from that unit.
All right, so you have 800,000 in unit upgrades. You got 100,000 on water conservation, and then maybe another 100,000 with the patios, the washer dryer rentals, and covered parking. So close to $1 million in NOI that you could add here across the deal. So in terms of where the deal sits now versus where you think you can take it, talk through that a little bit in terms of NOI.
Well, so we phased in the unit renovation program over 2 years. It's interesting when people just put it in year one, it's totally unrealistic because there's people that are living in the units, and you have to let the leases expire before you can go in and do that. So we phased it in over 2 years. So we phased it in over 2 years, so you can see how we've grown the income from 3.6 million to 4.184 million in the first year, and then all the way up to 4.7 in the second year as you phase that in. Their incomes their expenses are pretty much in line. Admin's a little bit high, so we cut that back, and then water sewer, of course, we use that water conservation quote to bring that down from $310 down to $200,000 a year. So you can see that, I mean, we're seeing NOI growth, 1.8 to 2.3 to 2.8, and then it starts settling in a little bit more, and you're not going to see the huge pops in years 3, 4, and 5, and then it just goes to 3.1, and then 3.27, and then 3.4.
And then there's no contracts or anything. This is just straight market rate deal with no lower or anything on the property, right?
That's correct.
Okay.
Offered
All right.
free and clear.
Okay. All right. So I think we mentioned it earlier. So Whisper is what's the Whisper price on this deal again?
So we're saying 46 million. I mean, that's north of a 3.5 cap. I think we're gonna go higher than that, just based on. I was talking to a guy the other day, and he said, "Well, everything seems to be like a 3.25, or maybe a 3.5. Why is this one's higher?" I said, "I know. You need to look at it. You need to come out and tour it." So yeah, so that's our Whisper. It's about 165 a door, which we're seeing a lot of these properties. 175, 180 a door for these 1980s deals. I think the thing that's crystal clear, and Nick and I talk about this often, is that we think in 2 years from now, all of these 80s deals, Class B and Class B submarkets are going to be over 200 a door. And so we're seeing it start to happen with some of the ones that are in a little bit better areas that are still 80s construction. We've got a 1980s deal under contract right now for 211 a door. And we're seeing, we're starting to see it happen. So I think getting into this deal and at this number, it's a good basis.
So I used to I started back in 2015, and the way I kept track of deals was if it was an 80s deal, it should be 80 a door. That's how I remembered it. But yeah, no, it's definitely moved. The rents have moved from that point, obviously, in the last 5 or 6 years. So yeah, that I can't use that anymore. So yeah, in terms of 46 million. I mean, if you look at it, Fannie Freddie with in-place rents, yeah, it's going to be pretty difficult to get higher leverage on the deal. So most people are going to look probably 70-75% bridge on this deal. We've seen people get up to 80, but most people are settling in around 75 on their the bridge loan quotes. And then depending on your rehab budget, if you're going to do all the units or most of the units, we put in 1.4 for rehab. And then we're seeing most deals settle around 3.5 to 375 on their spread over SOFR. And so, we'll take a look at your pro forma, make sure that you can exit the bridge loan. And, but that's what we're seeing on most of these deals right now in terms of non-recourse bridge. So in terms of wrapping up, what do you have a call for offers date yet on this deal?
Yeah, call for offers is Thursday, March 24th. And so, I've got a bunch of tours out there next week. And so I would encourage anybody that's interested to get out and see it. I think once you tour the property, you're going to like it better than before.
All right. Well, I appreciate you coming on and telling us the story here. And if anyone wants to reach out to learn more about a tour, definitely reach out to Bard. Here's his email and phone number, and get out, tour the deal, take a look at the deal, and come in with a strong offer. All right. Thanks a lot, Bard.
Thanks, James.